Welcome to our channel, where we provide a beginner's guide to investing in index funds, unlocking the potential of smart financial growth. Index funds offer beginners a solid entry point into the world of investing. With their focus on diversification, low costs, and a passive investment approach, index funds provide broad market exposure, reduced risk, and the potential for steady returns. They simplify the investment process and offer access to a range of sectors, making them an ideal starting point for new investors. Before we get started, make sure to hit that like button. Also subscribe to our channel. 1. Diversification. One of the key advantages of investing in index funds is the inherent diversification they offer. An index fund typically holds a basket of securities that replicate the performance of a specific market index, such as the S&P 500. This means that by investing in an index fund, you gain exposure to a wide range of companies across various industries. Diversification helps reduce the risk associated with investing in individual stocks, since a decline in one company's performance may be offset by the growth of others in the index. It allows you to spread your investments and potentially minimize the impact of any single investment on your overall portfolio. 2. Low-cost investment. Index funds are known for their cost-effectiveness. Compared to actively managed funds, which require a team of analysts and managers, index funds operate on a passive investment strategy. This approach eliminates the need for extensive research and frequent trading, resulting in lower management fees. Additionally, index funds tend to have lower expense ratios compared to other investment options, making them a cost-efficient choice for investors. 3. Passive investment strategy. Index funds follow a passive investment strategy, which means they aim to replicate the performance of a specific market index rather than trying to outperform it. This strategy is based on the belief that over the long term, markets tend to rise, and by holding a diversified portfolio of securities, an investor can capture the overall market returns. The passive approach eliminates the need for making frequent buy/sell decisions based on market timing or stock picking, making it an attractive option for beginners or those who prefer a more hands-off approach to investing. 4. Broad market exposure. Index funds provide investors with broad market exposure by replicating the performance of a specific market index. This means that by investing in an index fund, you gain exposure to a wide range of companies within that index, allowing you to participate in the overall performance of the market. 5. Reduced risk through market fluctuations. Index funds help reduce the risk associated with individual stock selection by diversifying your investment across multiple securities. This diversification helps mitigate the impact of market fluctuations, since the performance of one stock is unlikely to significantly affect the entire index. 6. Elimination of individual stock selection risk. One significant advantage of investing in index funds is the elimination of individual stock selection risk. When investing in individual stocks, there is a risk associated with selecting the wrong stocks or making poor investment decisions. However, with index funds, this risk is mitigated. Index funds hold a diversified portfolio of securities that replicate the performance of a specific market index. By investing in the index fund, investors gain exposure to a broad range of stocks, spreading the risk across multiple companies. This diversification helps reduce the impact of poor-performing stocks and eliminates the risk associated with individual stock selection, providing a more reliable and stable investment option. 7. Long-term investment potential. Index funds are well suited for long-term investors due to their long-term investment potential. Over extended periods, the stock market has historically shown an upward trajectory, and index funds aim to capture this growth. By holding an index fund for the long term, investors have the potential to benefit from the overall rise in the market. This long-term perspective helps mitigate the impact of short-term market volatility and allows investors to take advantage of compounding returns. Index funds provide exposure to a diversified portfolio of securities, spreading risk across multiple companies and sectors. As a result, they offer the potential for steady and consistent returns over time. By staying invested for the long haul, investors can ride out market fluctuations and position themselves to benefit from the long-term growth of the economy and the companies included in the index fund. 8. Easy to understand and manage. One of the key advantages of investing in index funds is their ease of understanding and management. Index funds follow a passive investment strategy, which means they aim to replicate the performance of a specific market index rather than actively selecting and managing individual stocks. This simplicity makes index funds accessible to investors of all experience levels, including beginners. The investment strategy is clear and transparent, as the fund's holdings mirror the composition of the target index. Additionally, index funds typically have low turnover, requiring minimal day-to-day management. This hands-off approach reduces the need for constant monitoring and decision-making, making index funds an attractive option for investors who prefer a more straightforward and less time-consuming investment approach. Overall, the simplicity and ease of management of index funds contribute to their popularity among a wide range of investors. 9. Access to a wide range of sectors and industries. Index funds provide investors with access to a wide range of sectors and industries, making them an attractive investment option. By tracking a specific market index, such as the S&P 500 or the NASDAQ, index funds hold a diverse portfolio of companies spanning various sectors, including technology, healthcare, finance, consumer goods, and more. This breadth of exposure allows investors to participate in the growth and performance of multiple industries within a single investment. It also helps mitigate risk by spreading investments across different sectors, reducing the impact of any single industry's performance on the overall portfolio. Furthermore, having exposure to a diverse range of sectors can provide opportunities for investors to capitalize on sector-specific trends and opportunities, enhancing the potential for long-term returns. 10. Potential for steady, consistent returns. One of the appealing aspects of investing in index funds is the potential for steady, consistent returns. While they may not offer the allure of high-flying individual stocks, index funds aim to capture the overall market performance over the long term. They provide broad market exposure, allowing investors to benefit from the collective growth of a diversified portfolio. By spreading investments across multiple companies and sectors, index funds can help mitigate the impact of any single stock's performance on the overall returns. This diversification and long-term approach can lead to more stable and predictable returns compared to more concentrated or actively managed investments. While individual years may experience fluctuations, index funds historically have shown resilience and the potential to deliver reliable growth over extended investment horizons. In conclusion, investing in index funds provides beginners with a simple and effective way to participate in the market's growth. With diversification, low costs, and a passive strategy, index funds offer broad market exposure, reduced risk, and potential for steady returns. They provide access to various sectors and industries, making them an excellent choice for long-term investors seeking a hassle-free investment option. If you found this information interesting, don't forget to like and subscribe to our channel for more captivating content.